It's our week 6 weekend update video. This is Professor Hassey speaking to you live and in color from beautiful Claremont, California. And this is the first of 3 videos being posted this weekend of May 13 and 14. Within 48 hours, 3 videos. Yes, you're going to get sick of me at the end of this weekend. If you've not already are sick of me. The first video today is just to go over briefly case number 2 solution file and to finish our lecture video spreadsheet on financial statement analysis and forecasting. Then a second video will be posted on Saturday, which will be a review or a update of the electrics case and some. If you notice, if you go to the Business 630 assessment case file folder in Blackboard, you'll see a checklist of items to prepare for that analysis. I will go over that checklist in my Saturday video. Remember, a week from this Saturday, May 20th, we have a review session for the electrics case paper. And then on Sunday, the final of 3 videos for this weekend, a introduction to case number 3, which will be a PowerPoint financial statement analysis of your company that you selected in the very first week of this course. And that will be an introduction video posted this Sunday. So 3 videos in 48 hours, a scary thought to say the least. So let's just make sure we know where we are right now as we begin our week 6 weekend video. If you go to the week 6 file folder, you will see some review files, one that we started in our lecture video and some our lecture video for the week. Remember, there's no specific graded assignment due this Sunday for this week 6. You are to begin work on your electrics case and see the posting of case number 3 later on this weekend. If you go to the electrics case file folder, you see that checklist that I was just talking about, and I will review this in our video on posted on this Saturday, a checklist of things to get, information or data to get, variables to get, so you can complete the spreadsheet analysis and write the paper for that electrics case. So that's where we stand right now. So let's take a look, one last look at case number 2. Okay, case number 2. Excuse my voice today. I've got a frog in my throat for some reason. But case number 2, again, was a practice of the capital budget analysis of the steps to go to determine the cost of capital and the return on investment into an asset. And also, it's a prelude to the template to the analysis you'll be using in the electrics case. Now, there's no template spreadsheet for the electrics case, so you are to take hopefully you can use this spreadsheet as an example. But remember, and this is where some of our students in case number 2 got points taken off, is when you transition from one case analysis to another, you got to make sure you clean up your formulas and you clean up your numbers, or you'll get some of those numbers from that older spreadsheet or that template mixed up with the newer variables of your new spreadsheet, and then you get problems wrong. And so that's where most of the points were taken off in our analysis of case number 2, just to transition from one set of variables to another set of variables caused some problems for some people. So again, we were asked to do a cost of capital with the variety of different a capital structure of 65% debt and 35% equity. You are asked to determine the after-tax cost of debt, which is 6.8%, which is the interest rate on the debt times 1 minus the tax rate of 20%. You're asked to determine the cost of equity using the capital asset pricing model with a risk-free interest rate of 3.5%, a market premium rate of 9%, and a beta of 1.25. Because I gave you the market premium rate, there is no need to subtract the risk-free rate because that's already been calculated in what is called the market premium. The other rate you might see is the market rate. Then the market premium rate would be the market rate minus the risk-free rate. Clear as mud. So the cost of capital under the cost of equity of the capital asset pricing model was 14.75%. So again, you weight the after-tax debt by 65%, you get 4.42, and you weight the 14.75% cost of equity by the capital structure, 35%, 5.16, and you get 9.58%. That's our discount rate. That's our hurdle rate. That's our opportunity cost of capital. That's our weighted average cost of capital. No matter how you say it, it's the cost of money at this particular time for this company. This could change daily if interest rates change or credit risk change. But at this particular time point that we're doing this analysis, 9.58% is our WACC. All right. So then what we did is we put this into the data provided, a 7-year investment of $700,000 depreciated at $100,000 a year for 7 years with a salvage value or an ending value disbursement of $55,000 in cash as a disposal of that asset. With the various projected units sold by the company, the selling price per unit and the inflation rate attached to that, the variable cost per unit, the cost of manufacturing and producing that product with an inflation rate of 1.5%, a fixed cost rate of $75,000 a year with an inflation rate of 1.5%. A tax rate naturally of 20% and an 8% working capital. Putting all that together, you determine a total discounted cash flow of $1,628,531. That's taking in net income, adding back in after-tax disposal value, depreciation, and the working capital rates, and you get the net cash flow. That net cash flow is discounted at 9.5%, giving us an NPV of approximately $784,531, with an internal rate of return of a little bit over 31%, a profitability index of 1.93 to 1, and a payback of a little bit under 3 years. So as you can see, in this particular capital budget problem, it's profitable. And so yes would be probably this good interpretation of would you proceed with this investment and actually allocate and invest $700,000 in this investment. Probably a good case for yes. Now, in the electrics case, you'll be writing a paper to supplement what that yes means. You'll be answering a series of questions provided in the case, and that's your paper. But you have to do the analysis first in a spreadsheet like this one. In the case of electrics case, and we'll talk more about this in my Saturday video, in the case of the electrics case, you're doing 2 spreadsheets for 2 different types of products. And that's what we'll be discussing and determining in that analysis. So the analysis is a little bit more complicated, a little bit more longer, a little bit different numbers, a little bit more calculations of the variables. And that's what you have to spend your time on, and should be beginning to do that immediately so you can properly finish that work up in the next couple of weeks. And then we get into the risk analysis, which is taking a look at key events. In the scenario analysis is taking a look at how the units sold every year will change from best to worst to base scenarios, weighted by a proper probability, and determining the weighted average net present value under those concepts of different sales per project. Then the sensitivity analysis, taking a look at 3 key variables: selling price per unit, variable cost per unit, and fixed costs, and decreasing them and increasing them by a set percentage rates, and determining their NPVs at those different rates per the change in each individual variable, and determining the sensitivity and the risk of those occurring. The steeper the line, the more sensitive it is to change. If we change selling price per unit, that has the greater change on profit naturally than if we would change the fixed costs. Fixed costs are a fixed rate, so that naturally the line is a little flatter. You'll be doing this analysis also in the electrics case, both scenario and sensitivity. So this was good practice for that case. But remember, the case is different, the longer terms. You don't have a template. You have to create your own, but you can use this as a sample. But if you do use it as a sample and fill in the numbers from the case right here, you have to make sure you properly adjust all the variables, all the cells in the analysis. And that takes a little bit of concentration and discipline to do that. And that's what I'm looking for as you set up the electrics case. Okay, more on that a little bit later. Okay, here's the financial statement analysis worksheet file that we started in our lecture video at the beginning of week 6. Remember, in this section of the course, we have made the investment in our assets, and now we're reconciling and reviewing strategically for what has happened and what that tells us about the performance of our company and about our financial management. We're looking at it in terms of the financial statements, the income statement, the balance sheet, and the statement of cash flow. We're looking at it in terms of the financial analysis of the company by taking a look at the free cash flow. We're taking a look at the trends in the company, both through key variables of liquidity, debt management, profit, and market relationship, current ratio, debt ratio, profit margin on sales, and et cetera. We looked at how to calculate those numbers. Those numbers are also, you were provided a financial statement analysis PDF in week 6, which gives you the basics of those definitions and those ways of calculating them and the equations supplementing them. And so you're going to be doing this in your case number 3 work in a PowerPoint presentation, and I'll introduce that on Sunday. But you'll be looking at key variables of your companies, finding those trends over a couple of years, finding those explanations of what is happening to your company financially, and in trend, and also comparing it to the industry they're in or the market they're in or their competitors. That's what case 3 is about. Case 1 was taking a look at the credit and the risk of your company. Case 2 was looking at spreadsheet and investment return analysis. Case 3 is looking at the trends and the financial statement data, what it tells you about the company. And the electrics case is telling you to wrap all this into one package in a paper and a spreadsheet presentation. All these 4 assessments are assessing you and your ability to gather data, review data, and interpret data and what it tells you about a particular organization. All keys, disciplines in MBA study, being able to interpret data and then presenting them in a rational, disciplined environment that the reader can interpret what you're trying to say about this company. So now we're going to pick up the last tab of this week 6 lecture review spreadsheet, and it's called financial forecasting. It's taking a look at what we think is going to happen based on our current financial statement data, what we project out into the future. If you remember at the beginning slide of this spreadsheet, we had 3 areas we're looking at. Statement of cash flow, which is the efficiency of the organization. Are we generating and managing our cash effectively? The second was the trends in the financial statement review, looking at key interpreted ratios and analysis, tell us something about the business. And finally, what are our future capital needs? What kind of money do we need if we want to grow the business? Where are we going to go and get our capital? Remember, there are 3 legal sources of capital. You can borrow it, you can have equity investment, or people invest in your business, equity, and you can make a profit. Well, those first 2 of debt and equity is what is called external sources of capital. The internal sources of capital is hopefully making profits to fund your future needs. Well, how much cash or capital do I need in the future, and how am I going to fund it? Am I going to fund it by profits, or do I have to plan on going to the markets and borrowing money or issuing new equity or finding equity partners? These are the tools that companies use to determine those capital needs and where they get the money. Remember, any company worth its salt and is going to continue on and on into the future must think into the future. How are they going to grow? How are they going to stay competitive? How are they going to continue their market share? How are they going to be able to attract fine and good people to work for them? Companies need to show that they are progressing forward, not backwards. A very fatal flaw in corporations is being able to attract people, attract capital, attract ideas and change so you can stay competitive and efficient in the workplace. Many of you out there in MBA land, why are you getting an MBA? Well, probably one of the reasons is you want to stay competitive in the work environment. You want to have your skills so you can meet the challenges of the future in business, in entrepreneurship, in running your own business affairs. So that's what you're trying to do. You're looking forward. You're not looking back. But in order to look forward, we have to have the ability to look at the past and project. This is called an AFN analysis, or a percentage of sales analysis. In other words, we anticipate 15% increase in sales. Where are we going to get the money to grow 15%? And as I was just telling you, some of it comes from external sources, the interest on debt and the issuance of stock or equity in your business. Could be private investments, mergers, private investment as a merger into your organization. Those both two ways are very expensive. You got to pay interest. You're giving up part of the company. You're paying dividends. Expensive. Then there's internal sources, which are either borrowing money short term, current operating liabilities, accounts payable. That's a good, cheap source of capital. But the bad thing about it is you got to pay it back probably in 30 days. So you got to really manage your affairs very well to be able to do that. A second internal source is the profits of the company. So this analysis is taking financial statement analysis information from the past, in this case, to 2022, and projecting out into the future, 2023, of what you need to produce a 15% increase in sales. Now, it doesn't have to be 15%, but maybe you're under pressure in your company to grow, to fight the competitive markets. So look at this question number 3 here. The firm would like the sales to increase 15% for 2023. Using the AFN model, which is in Chapter 12, what additional capital would be required from external sources for 2023? In other words, what additional money do you need to borrow? What additional money do you need maybe to issue some equity or stock in the next year if you want to achieve 15% increase in sales? The assumptions, naturally in any model or modeling, there's assumptions. The profit margin and the dividend payout percentages will remain in 2023 as in 2022, because that's important. The profit margins that you make and the dividend payout, that means how much excess profits you have available to fund your 15% increase in sales, which require purchase of additional assets to fund those and produce those sales. One of the interesting things about this is it's a model, it's a projection, but it gives you a good testing of what is required by you to grow your business. Now, 15% is a pretty hefty growth rate, but if any of you remember in the heyday years of Apple about 5-6 years ago, Apple was growing at 25% a year. Amazon for many years was growing at almost 30% a year. It's not that way now, especially with the pandemic, but some businesses continue to grow at that rate. How it takes capital to fund that huge growth rate. That's why eventually they slow down. You just can't get enough capital, or you just can't maintain those huge sales increases and profit increases. But you still need to increase them 5%, 6% every year to stay competitive, to stay efficient in your industry. So the model says, or the model has to do with, get that over here. It takes what we anticipate increasing sales by 15%, and we increase the assets by 15%. That's why it's called the percent of sales. So if we anticipate a 15% increase in sales, that means our assets are going to go from 3.5 to a little bit over $4 million, which is a 15% increase. That means we need $527,543 to purchase additional assets to fund a 15% increase in sales. All right. Well, it's got to come from a variety of sources. But first of all, we'll determine how much of that 527 we can generate internally in our business. What sources can we generate to provide some of the capital that we need to grow sales? And one of them is our current operating liabilities, accounts payable. If we increase the two operating liability accounts from 2022, accounts payable and accruals. Remember, notes payable is a note, a long-term note that's just that portion of that note is due in the next year. So that's considered long-term debt, really. So the two operating liability accounts, which is $739,800, and increase those by also the 15% increase in sales. We think we're going to sell more, we're going to purchase 15% more assets, so we assume we're going to borrow short-term 15% more. That gives us $110,970 of additional capital from short-term borrowing that we can use to pay for that 527 increase in sales. So that portion's covered by just borrowing more money short-term and paying it off in 30 days. At the same time, we're going to increase our sales by 15%. That means our profit is going to increase. Well, remember in 2022, our profit margin was 3.6%. So we assume that if a 15% increase in sales, which would mean bring sales to a little bit over $8 million, we take 3.6% of that, our profits are going to jump to $291,622. If you also remember in 2022, we paid 22 cents a share in dividends, which was a 21.69% dividend allocation, which is the percentage of dividends as a percent of net income. So we paid out a little bit, almost 22% of our profits to dividends. Well, we'll maintain that same percentage in 2023. So we'll pay out 21.69% of our profits in dividends, which would be roughly our dividend next year to shareholders will be $63,250. Companies do this all the time. They project out what they're going to be doing the next year to make sure their shareholders feel comfortable with the business is doing. These are called quarterly or yearly CFO earnings calls or earnings reports to the market. They do this every quarter. So if we do that, if we have a profit projected next year, if we have a dividend projected next year, that's going to give us $228,000 of additional profits that we can use to fund this increase in our assets to produce the increase in sales. So now we've calculated we're going to need a little bit over $500,000. 110,000 of it's going to come from operating liabilities and short-term debt, and 228,000 of it is going to come from profits. The difference is called our additional funds needed. The difference between the change in assets minus the change in operating liabilities minus the increased retained earnings of the year. The balance is $188,201, meaning the company now has to go to external sources to find the additional capital requirements to fund the increase in sales. So that means $188,201 of additional bond borrowing from a bank, issuing additional stock, finding a partner. Those are called external sources needed to make our projections work. Now, the strategies that develop from that is, let's say, oh, that's too much money. I don't want to go out and borrow money. Well, what we'll say is, okay, let's don't pay a dividend next year. We won't pay the dividend to our shareholders, and that'll give us additional capital to use to pay for the increase. And that means our AFN will reduce down by the 63,250 to 124,951. In other words, we have a little bit more money to invest in the business as an internal source. That means it reduces our external capital needs by don't paying a dividend. And companies do this. We want to stay competitive in our market. We're not going to pay you a dividend next year and reinvest that dividend back into the company. And hopefully down the road, it'll increase the value and the return of the stock for you down the road. But for now, we're not paying you a dividend this year. Sometimes investors buy that. Sometimes they don't. But that's one strategy. Don't pay a dividend. Another strategy, which is very popular, is try to increase your profit. Remember, our profit margin last year was 3.6. Why don't we try to shoot for an increased profit of 7%? If we increase profit by 7%, that'll give us more than enough capital that we don't have to go external. The problem is, how do you increase profit by 7%? Do you increase your selling price? Or probably the route to do is you cut your expenses. You become more efficient as an organization. You find additional ways of saving money to increase your profits. And that's our world that a lot of us work in. Every year we have budget constraints, budget issues, lowering costs, finding cheaper money. And that's what companies do so they don't have to resort to going to external sources, the most expensive sources of capital. They try to generate enough profits and return on their internal sources to fund growth rates. Doesn't always work that way. Apple Computer has existed for many years by creating more than enough profit to fund their capital. The same with Amazon, the same with the bigger companies. But small businesses who have very thin margins and can't make that much profit because of the competition, they have to go external. And that's where it gets very expensive and very dangerous, especially in high inflation, risky times that we are in today. So that's the puzzlement in the economy today in May of 2023. Companies are struggling to maintain profit margins so they don't have to go and pay those high interest rates in the debt market or high demands of dividends and stock in return on investment by investors. How do they cut costs? They lay off people. They become more efficient. They use technology to lower their costs by using computer systems and more technology systems to run their business. So the bottom line of this discussion of AFN or financial forecasting is being able to project with a model like we're doing here what your requirements and needs are going to be in the next year, and then developing your strategies and critical thinking along, well, can we do that? What do we need to do it better? And so on. And that's a very key component of financial management. First of all, understanding what your financials tell you, and then being able to use modeling to project in the future and what do we need, what strategic decisions do we need to go forward to stay more competitive. That's what the MBA graduates do in companies. They're the strategists. They're looking forward. They're not doing the day-to-day crunching of numbers. They're looking at what the business is going to need in the next year, 2 years, 3 years, and can they do that in the market and the competitive settings that you're in. You're going to be doing this all in case number 3 next week. So more on that later on this weekend. Okay, that's our weekend update video for today. Again, 2 more videos to follow this weekend. 1 video on the electrics case and 1 video introducing case number 3, financial statement analysis, a PowerPoint presentation. Okay, let's see. Let's make sure in week 6, the file that I just talked about that gave you a review of the key parts of case number 3 and financial statement analysis and forecasting. There it is right there, week 6 lecture review file. So you have that. And again, if you now go to the assessment case, you'll see a checklist of things that you need to be done, and they should be done in this order, by the way, and the tabs of the spreadsheet that I'm requiring. So notice there's going to be 9 tabs in your spreadsheet for this case. Now this is MBA work. Okay, that's where we stand right now. Stay tuned for the next video later on this weekend. Thank you all for your participation, and until next time, Professor Hasse, adios.